Good afternoon and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Before we get started, a few quick reminders. Anyone that is registered for today's program will be receiving a copy by the end of this week. And if you have any questions, feel free to enter them into the lower right side of your interface under the Q&A bar. Now, please join me in welcoming back our good friend, Cox Senior Economist, Charlie Chesbrough. Charlie, we last had you on in December, and a lot has happened over the past 3 months that I don't think anyone had on their bingo cards. So I'm going to let you get right into it and take it away.
All right. Well, thank you, Rachel. Yeah, a lot has gone on, and I'll apologize right up front because we're going to cover a lot of ground today because there's so many things to talk about. We're really starting to see some trends emerge in the data in this post-COVID environment that I just wanted to point out to everybody. And some of the topics we're going to cover today, I want to walk you through the U.S. economy. Some threats are starting to rise. Review where we are with the new vehicle market, and we're still stuck in low gear, and that's kind of the situation as it stands. Talk about the used vehicle market, and really the big issue I get from a lot of folks when I talk to them is, are prices going to crash? So I'm going to address that. And then I'm going to finish up by talking about electric vehicles. We talked about this before, I think, last time, but I know this is a hot topic, and we're really starting to see there's a lot of interest in electric vehicles here in the post-COVID marketplace. So we're going to cover that. But let's jump into it, and let's start with the good news out there, because there really is some tremendous news, and that is that COVID-19 appears to be behind us. I don't mean to say that entirely, but it does look like that the worst is certainly behind us. As we can see on the left here, this is daily reported cases. We had the big Omicron surge over the holidays. It's now down, and you can see that we're looking at levels for the virus out there that we haven't seen since the very early days. So I think we're heading into the summer months. I think there's reason to be optimistic that we're definitely in a much better situation with this virus than we have been before. On the right, we can look at how many vaccinations have been administered. It's starting to come down. Not as many going out. We just got news that the fourth shot is going to been approved, so people will start getting those. But overall, we've had about 65% of the population get a full vaccination now, got at least 2 shots. So that's pretty good, and that should help mitigate whatever new viruses might pop up over the summer. But the good news is clearly that we're moving in the right direction on this thing, and let's hope we don't have to talk about this again. But the other good news out there is the economy itself and job creation. We just got the numbers from the month of March, 431,000 jobs created. They added another 700,000 jobs that were missed for previous months' reporting, so we added even more jobs. The unemployment rate has now fallen to 3.6%. This is the lowest rate that we've had. You have to go back to like 1969, December, to see unemployment rates at that level. And just to let you know, the hot song in December 1969, Come Together by the Beatles. So that tells you how far back we got to go. So this is all good news, but it also means that there's a lot of inflationary pressure in the environment. And certainly this tight labor market has been putting upward pressure on wages, and that's inflationary. And then we also have gas prices that have been going on out there, and that's certainly inflationary. This is looking at weekly gas prices, and you can see here on the right, from where we were at in April of 2020 to where we were just last week, gas prices have gone up 138%. Nothing makes the American consumer more miserable than high gas prices. You can see it in almost everything. Biden's approval ratings way down, consumer confidence way down, fears about recession way up. High gas prices are very detrimental to the U.S. economy and certainly the psychology of the American consumer. And so it's really suffering right now, and good reason. It's made a substantial hit. Now, the only silver lining that I can see from all of this is it does present an opportunity to selling of vehicles that, hey, you might as well upgrade that vehicle, because if you get better fuel economy, you can save some money. And just to give you an idea of what we're talking about, I put this little grid together. If I'm a consumer and I'm driving a 15-mile-a-gallon vehicle, and you can put me in a 20-mile-per-gallon vehicle, and I drive 20,000 miles a year, you can save me $110 a month by making that 5-mile-a-gallon fuel improvement. So, or $111. So there's huge money to be saved there. And I think it does put fuel economy back on the front burner in terms of vehicle shoppers. So I just make that point for something that, if you got to put a silver lining on it, that's the only one I can really see. And we've also seen a lot more interest in electric vehicles, and I'll talk more about that. But certainly that's in response to these high gas prices as well. But the other big concern we have out there is interest rates. And the talk now is that the Fed is going to be raising interest rates aggressively in coming months. There's talk about a half-point increase. The concern is that we're starting to think that we may be on the cusp of a recession. And one of the things that folks are looking at is the yield curve. And that's what I'm showing here. This is 10-year Treasury notes minus the 2-year Treasury. And essentially what this chart is telling us is that it's gone negative. That to loan people, the people want a higher interest rate to lend them money for 2 years than they want to lend them money for 10 years. There's more concern about the near term than the long term. And this just flips sort of traditional theory on its head, where if you want to keep my money for 10 years, well, you better pay me a higher interest rate than if you just want to keep it for a short amount of time. But there's so much concern about inflationary pressure right now, it's reversed itself, and that means the yield curve has gone negative. And this means for banks that generally borrow short and lend long, it makes them vulnerable. They can't operate in that environment. So there's less credit that's generally extended in the economy, and that generally leads to some type of a pullback or a recession. This chart is showing about 45 years of history of this inverted yield curve. And I just want to point out that every time that this yield curve has gone below that red dotted line, meaning it's gone negative, the U.S. economy has had a recession within months afterward. And in fact, where we are right now, as of the end of last week, we went negative. And so there's real concern that sometime in the next few months, the U.S. economy may start to slide into recession. So that's why you're going to hear a lot more about that with this inverted yield curve. But that doesn't necessarily mean that auto loan rates are going to go get out of hand. But there certainly is more risk that auto loan rates are likely to rise. This is a chart that's showing some of the key interest rates in the U.S. economy. In dark blue, we've got U.S. 10-year treasuries. In green, we have the 30-year mortgage. We have the prime rate in light blue. And then we have our average interest rate, or APR, for automotive in red, and then the subprime rate in orange. And the key takeaway here is that you can see over the last 3 years, interest rates in general have been declining mildly. But we have seen over the last couple months, really since December, a mild uptick in these interest rates, particularly in the automotive rates. Not a lot, but a little. So it does suggest that there is some vulnerability here that rates could rise. Now, just to give you an idea of what that would mean to monthly payments, a 2% rise in interest rates. So if we went from, say, a 5 to a 7% on an average rate on a $25,000 loan, that would add $24 to that monthly payment. Or a $50,000 loan would be about $47. So back of the envelope, 2% adds 6% if you had to think of it that way. But certainly that means that we're vulnerable. If the Fed really starts to get aggressive on raising interest rates, we're likely to see those monthly payments go up, and that could be something detrimental. The other concern we have, though, is credit availability. Is there, if we enter a recessionary environment, is it possible that not only will rates be higher, but that banks may be less willing to lend to the automotive sector? So far, the data on that suggests no, and in fact, quite the opposite. This is a chart that's showing loan originations as tracked by the Federal Reserve. And you can see here on the far right, I've circled it, that over the last few quarters, we've seen actually a surge in loan originations. So there's a lot of credit that's being extended to the automotive sector. And I think part of the reason for that is that we learned some lessons from the 2008-2009 recession. And that is that lending to the automotive sector didn't see the kind of defaults that we saw on other kinds of personal loans. When people studied that period, you can see that defaults on credit card statements had a huge spike in defaults. Defaults on their home loan payments, their home mortgage, spiked tremendously. But when you look at 2007, 2008, and you look at defaults on auto loans, they did not have near the same level of spike. And what we saw is that even in turbulent times, people pay their car loan. They need that personal transportation. And so it may be, and in fact, if you look in the immediate days after the Great Recession, when we started the rebuilding phase, there was a tremendous amount of lending that was done to the automotive sector. And that's really what fueled the quick recovery that we had in automotive over that decade period. Well, what we can see now is that there's still a lot of lending that's being done to automotive, And part of the reason as well is that subprime isn't out of hand. That red line there is showing subprime share of overall lending. And you can see that during 2007, 2008, it was a much higher level, almost 25, 30% of loans were to subprime. You can see it's in a much more reasonable level. We're sort of in the 16, 17% range today. So it's not like a lot of crazy lending was done out there to folks that may have difficulty paying that loan if we hit a recessionary environment. So lending may still flow even though interest rates are going up. The other issue that we have out there that gives us a little optimism for what's happening is that tax refunds are still yet to come. And that means that we're going to have a lot of buyers out there in the next couple months that are getting those checks are going to be ready to go out and buy vehicles. We know that tax season is very important for the used vehicle market. And so this fact, I think, will be helpful, that we'll see April and May have particularly strong buying seasons. And that's because tax refunds are delayed. What this chart is showing here is on the bars is the percentage of folks that have received their tax return by week. And so we're now at week 11 from when tax season really starts, and only about 40% of people have received their tax return so far, their tax refund. In 2019, our last pre-COVID year, at this point, about 65% of people had received their tax refund. So there's a whole bunch of folks that have still not received their tax refund. And the other optimistic thing is it's going to be more. We're going to see a tax refund on average about 13% higher this year than it was in 2019. So it's a little bit delayed, but it's going to be more money. So all of that suggests that there is going to be resources out there for consumers to be buying this spring. But of course, when they come to the marketplace and they come to your dealerships, they're going to see used vehicle prices much higher than they have been in the past, and certainly new vehicle prices as well. So that's not to say that they're not still in for a shock when they get there. So let's talk about the new vehicle market. And we just got the March numbers, and they came in, unfortunately, about where we expected them, which was down. The SAAR came in at about a 13.3 million pace in March, and sales came in at about 1.25 million. That was down about 22% from what we had sold in March of last year. Now, the comparisons to last year are a little bit challenging because we really had a hot spring last year. March, April, and May of 2021 were three of the best selling months that we've had since the Great Recession. But that's what kind of created the hole that we dug ourselves that we're in today. We had all this tremendous sales activity last spring, but we didn't have the inventory or the supply in order to refill the backfill. We weren't able to restock the shelves after all that product sold. And that's what put us into this lean inventory environment, and we've been stuck there since. Sales have been stuck at around 1.808 million since last August. That's been the average. And we just can't move from that. The SAAR has been moving a little bit because there's seasonality effects, but the volume has been fairly stable over the last 7-8 months. So until we see volume change dramatically in terms of supply, sales aren't going to really budge. And so that's where we are right now. Because we're seeing really no significant gains in the supply situation out there, on top of additional concerns now we have regarding inflation as well as the war in Ukraine, we've had to make an adjustment on what our guidance is for what this year will be for the new vehicle market. We've lowered our forecast now to 15.3 million from the 16 million we were before. And frankly, at this point, I'd say that's an optimistic view because we have to build in an assumption that the second half of the year is going to be substantially better in terms of supply availability than we have right now. The current pace of the market is more of a 13 to 14 million market for the year. And so, almost a step backward. So really, and I think all forecasters are expecting the second half to be better, but we just don't know. The only people who really know are probably the purchasing managers at these OEMs when they're opening up their FedEx boxes of chips. They're the only ones who know how many vehicles are going to be able to put out the door that day. It's a very, very challenging environment to try and forecast in. But the other interesting thing we're seeing out there is that the way that the industry is coming to market has been changing as well. And the share that's been going through different channels has changed dramatically prior and post-COVID. On the left here, I'm showing retail lease share of retail sales activity. Normally, and you can see in light gray here, that's 2019, what lease share was in 2019 each month. Normally, it's in sort of the 30% range. Almost 1 out of 3 vehicles is leased in the retail channel. But that's fallen dramatically. And if you look at that dark blue line from 2021, you can see that just as we got done with that hot spring selling season and the chip shortage really started to kick in, lease share started to fall dramatically. And now you can see in January, we're looking at about 20% is the lease share. There's a little bit of a delay on this. I don't have February and March numbers yet, but we expect they're going to be in a similar area. And the reason is that the industry's just pulled back, that there's no need to do the extra cost to provide leasing because it's generally a little bit more subsidized product than a retail purchase. And so the industry has pulled back. And as a result of that, that means, of course, there's great opportunity that if they see retail sales start to wane, they could start to get aggressive again on leasing to try and boost sales activity. The other issue we're seeing, of course, is fleet activity, and that too has fallen dramatically in the post-COVID market. In 2019, fleet share was about 19% of all sales. In 2021, it was only 13% of the market. And you can see where we are in January, we're basically in the same spot. Again, this provides a huge opportunity for the manufacturers that if they see that retail demand starts to wane, they certainly could get aggressive with providing fleet vehicles, particularly to the rental car industry, if they had someone they needed someone to take that production. The rental car companies probably didn't want those products back in 2020, but once we had the recovery in 2021 and certainly this year, they would love to get their hands on more new fleet vehicles. But they're challenging. They're challenged like everybody else and competing with us and trying to get their hands on those vehicles. But certainly both of these channels being low provide opportunity for the industry going forward. Do they want to remain lean and mean? And I think that's really the big question that we're wrestling with right now. Looking at the inventory situation today, there's really not much new to report from what I told you back in December. The way we see it right now in red is what we're looking at on the left here for supply around the country. This is the total of what is on dealer lots all around the country, a little over a million units. It's down 57% from what we had this same week last year. We're down 2.4 million vehicles from where we were this same week back in 2020. So it's tight out there, as I'm sure you're well aware. And we look at days of supply. How long will this existing inventory last based on current sales trend? Well, as you can see, it's essentially flatlined at about 30 days. I mean, essentially in our measure, almost everything coming in is selling almost immediately. And in fact, a huge portion of activity today is simply delivery of vehicles that have long been ordered. We're hearing anywhere from 50 to 60, 70% of all activity is stuff that was ordered months ago. So again, until we see the supply really start to make a significant move, we're not going to see sales make a significant move. When we look at the industry for the different brands out there, there really is quite a varied situation. We can see that Toyota, Kia, Lexus, Honda, many of the Asian manufacturers are in an extremely tight supply situation. But that doesn't necessarily mean that their operations are completely hindered. Toyota won the sales title in 2021, best-selling OEM, and they won the first quarter as well. Yet they've had tight inventories for all of this COVID period. So they seem to be doing something right. At the other end of the spectrum, you can see there's a lot of American brands that have much higher days supply than the nation. That would suggest that American brands have a little bit more availability. There's more days supply. But I think one of the things that we're learning from all of this is that all these companies operate differently. They require different levels of inventory in order to have a very successful sales operations going. And for the American companies, I think we're learning that they need to have a much higher days of supply because they have a much larger dealership network and maybe their products are a little bit more complex. When you talk about pickup trucks, there's so many configurations available of king cab, crew cab, four-wheel drive, two-wheel drive, diesel engine, electric engines now. There's many different configurations, and having the right product in the right market for the right buyer may be particularly challenging for the Detroit manufacturers. And we've seen that their market share has been suffering significantly, and I think that that's probably one of the main contributing factors is just their complexity in this tight inventory environment. Here's a chart that's looking at all the different market shares, and I think this is really helpful to try and understand what's been happening during this COVID era. And a couple things just to point out to you, we can see here in the upper left, the Asian brands in dark blue made some massive share gains last year. When the chip shortage hit in the spring of last year, it does appear that the Asian brands weren't hit quite as hard as everybody else, at least in the early stages, certainly not as much as the Americans. And they were able to gain significant market share during this period. But you can see that in the latter half of last year, they started to give it back. And then this year, in yellow, we can see that their market share is pretty much on par with what they were doing back in 2019. And if we look underneath them, we can see the Europeans, they too had a very strong year last year. And then so far this year, they too seem to be following market share patterns to what they had back in 2019. But who's been suffering, you can see the American brands. That's there on the upper right. Market share last year fell through the floor as the chip shortage really took hold. Again, those pickup trucks was very hard to keep the right product in the right market. They lost a lot of market share. And so far, we can see in 2022, they haven't gained that share back. They're still down a good 3-4 points from what they were doing prior to COVID. Who's been the beneficiary of all this? Well, it does appear that the EV OEMs, which is pretty much still Tesla at this point, but there are some new players out there with Rivian and Lucid. But Tesla made huge gains during this COVID period. And in fact, you can see that in 2021, as the chip shortage was hitting the industry, Tesla was really able to gain significant market share. And almost all of that's on the back of their new Model Y and that successful rollout they had. And they've been able to hold that market share gains that they had last year. So Tesla is here and they're here to stay. And so far, it looks like the American brands are the ones suffering a little bit, although I don't know that it's a direct taking of American customers, the Detroit 3 customers, but I do think it's reflecting maybe a new strategy that's emerging from the American brands. And I don't know they're in such a hurry to get back to the market share that they had before. So the other big issue we're dealing out there, of course, is transaction prices. We just got this data point from sales that closed last week. March sales finished with transaction prices near $46,000, up 13% from what we had done in March of last year. I mean, that's a monster year-over-year increase in the new vehicle market. Now, there's always a little bit of inflation in new vehicles, and you can see in that gray line in 2019 that vehicle prices generally do rise through the course of the year in the new vehicle market. You generally start January with sort of the post-holiday blues, not a lot of big sales. Products are introduced through the course of the year, and certainly when you get to the fall, the new model years are released. And then by the fourth quarter, you have the holiday selling season, which is always an important time for the luxury brands. So there is a little bit of an upward bent to this. And you can see in 2019 and in 2020 that prices went up, but generally within sort of that 3 to 4% price increase that we generally see year to year. But you can see in 2021, when that supply shortage hit, prices really started to rise on a different trajectory. And that's what we're seeing. Our expectation is that as we get close to the year anniversary of the supply shortage in May, we're going to start to see the year-over-year growth rate of vehicle prices come down. The basis effect is going to start to take place. And essentially, we will settle down into pricing patterns starting to rise just like they always did before, except we're going to be at a new level. We're at a new higher plane for vehicle prices. We don't expect to see vehicle prices to come crashing down. And the other thing we're seeing out there is that prices remain strong. They're very rigid. This is a seller's market. We can look at that blue line is looking at incentives as a percent of transaction price. And prior COVID in 2019, generally it was around 10 to 11% was the incentive as a percent of the transaction price. You can see that this has fallen dramatically post-COVID. And our most recent data point from March shows that this fell to 3.2%. So it's down dramatically. And the other thing that we can measure is the price strength. What is the price relative to the MSRP? Prior to COVID, this was more in the 94, 95% range was the transaction price relative to the MSRP. But since COVID, you can see that green line has risen dramatically. And now our most recent data point is showing that the price is 103% of the MSRP. So it is definitely a seller's market. There's not a lot of negotiation to be done. And that's one of the reasons we think that this industry may not be in any hurry to get back to normal, because things are pretty good here at these higher price points. we can look at market revenue, and this is a very simple number of vehicles sold times transaction price calculation. And we can see that where we are right now in red, that revenues this year are basically on par with what we did in 2019, that gray line. But we know we're doing substantially fewer sales, and that's the advantage to having these new higher price points. And just to give you the big picture, in 2019, total revenue for this industry was $647 billion. That's with 17 million vehicles sold. In 2021, we did $650 billion, $3 billion more, and we sold nearly 2 million fewer vehicles. So that's the transformation that's going on in the marketplace. And the question is how desperate are all the different manufacturers to get back to full dealer stock shelves, 60-day supply out there? It just doesn't seem like it's necessary if they can keep these kind of margins going. And we also can hear from the dealers themselves that they may not be in any such a hurry to get things back to the way they were before. We have the Dealer Sentiment Index. I think many of you have probably been surveyed for it. We do this each quarter, and we ask dealers around the country, franchise and independent dealers, what do they see out there in the marketplace? And one of the questions we ask is, how would you describe the current market for vehicles in the area that you operate? And you can see on the far right here that the latest data point for franchise dealers is 66. It's down a little bit from what it was in the fourth quarter, but it still remains well above levels that we were at prior to COVID. That the franchise dealers, as well as all dealers, are telling us that they still see the business environment as being pretty positive out there. And then we ask them, what is your outlook when you look at the next 3 months? What's your level of optimism? And you can see there on the far right that dealers in general are optimistic and are either holding or getting a little bit more optimistic as to what they think is going to happen here over the near term. So yes, the tight supply is out there, but people are still seem to think that their business is doing well. And we also ask them, and we'll start with question 8 here in blue, how would you describe the current new vehicle inventory levels? And you can see that dealers out there say that, yes, they recognize that supply is difficult to get. We did see a nice little jump to 25 regarding this question about inventory levels. So I see a little bit of improvement out there as stated. But the big question there is that green one. How would you describe your profits over the past 3 months? And you can see that we're looking at profits in 81. In our measure, it's down a little bit from our peak, but it's well above the levels that we saw prior to COVID. And that what dealers are telling us is, yes, the supply situation is tight, but our profits are really good. And so I think that's the combination where we keep asking ourselves is why get back to normal? What's the rush? The other interesting trend that we're seeing out there is that the type of buyer that's coming into the marketplace is changing. And this is a chart that's looking at new vehicle buyer income. And IHS Markit has this registrations data where they're able to identify the different income groups. And what we know is that in 2021, 35% of the new vehicles purchased were bought by people with incomes less than $75,000. So that's about a 2% decline from the year prior. And where did the incomes come from? Well, we can see that people with incomes of $150,000 or more saw their share of the market rise to 30% of the market, up from just over 28%. So the average income out there is rising, and we estimate that the average income in general for a vehicle buyer in 2021 was around $124,000. So, this concept that new vehicles are a product for everybody, well, that's an old thinking. That's not where we are today. New vehicles are for the affluent. I don't think there's any way to slice it. And even when you look at the incomes less than $75,000, that includes a lot of retirees that aren't making any income but do have a whole bunch of money sitting in the bank. So, we have to recognize that who is buying in the new vehicle market is changing, and they're becoming a more wealthy type of buyer. And that means that the type of products that they're going to be buying is changing. And we can see that reflected in the marketplace. This is a chart in blue that's showing luxury brand share of all sales. And by luxury brand, I'm considering Audi and Mercedes-Benz, BMW, sort of your traditional larger and well-known luxury brands. And you can see that from 2012 to 2021, that luxury share has gone from around 11 closer to 13% of the market. When you throw in Tesla, that gives you that green luxury brand market share. And so with Tesla, it's actually risen even higher. We're looking at over 15% market share for luxury brands. So the role of more expensive products in this marketplace has been rising tremendously. And that means that we're going to have a different kind of buyer out there that's going to be able to qualify for a different kind of interest rate. And in fact, that's exactly what we're seeing in the data. On the left here, this is showing the average APR, the average contracted interest rate for a vehicle purchaser. This comes from our dealer track data. And this goes back to 2019. And you can see that in 2019, about the average interest rate on a purchase contract was around 6%. But then COVID hit, and you can see it. The floor just dropped out. It fell tremendously. And now we're stuck more in around 4.5% is the average interest rate for a vehicle purchase. So what happened? Well, a couple things went on. One, we think that there was more subvention of interest rates. We know that there was a lot of 0% financing offers in the days immediately after when COVID hit. So there is some interest rate subvention. But we also think that the finances of vehicle buyers improved. We know that in general, consumer finances are very healthy. And for folks that did not lose their job during COVID, and in fact were employed and then getting checks for thousands of dollars from the government, their finances were strengthened during COVID. And so that in itself would suggest that they can get a better interest rate. And at the other end, you have folks that could no longer afford a new vehicle. They did suffer during the COVID crisis. And so they dropped out of the new vehicle market, weren't even going to purchase. And so those folks who would likely be paying a higher interest rate means that the average improves. And so that brings down the average. But all of this means that we have a different type of credit buyer in the market. And on the right, you can really see how this isn't just a quick change. This has been something that's been going on for quite some time. This is the percentage of the market for the different interest rate bands. And so in 2019, you can see that 14% of purchasers were paying between a 0 and a 2% interest rate. And 47% of purchasers were paying between a 2 and a 6% interest rate. And then you had 24% paying between a 6 and a 10% interest rate. And then you had 15% of the market paying a 10% interest rate or more, right? Those would probably be your more subprime type buyers. And then you can see on the right, where are we today? Well, you can see that on the lower end, the shares of people who are paying those high interest rates has really dropped in half. So we've lost a whole bunch of folks out of this marketplace who are the more questionable credit. And what remains are people with higher incomes who are going to get a better interest rate. But that also means that the brands are affected differently out there because these brands cater to different types of credit quality buyers. What we can see from this chart, this is showing the different average interest rates for the major brands out there. In red, we can see Nissan. Nissan buyers back in 2019 were paying around an 8% interest rate, much higher than the other big brands out there. And then at the other end, you can see Honda. Their buyers in 2019 were paying more of like a 3.5% interest rate. So a much different type of buyer out there for those two companies. But look what's interesting and what we're happening. A couple of things have been emerging from this chart, which I think are very, very interesting. One, you can see that Nissan's actually seeing their average interest rate improve over this time. It's gone from an 8 down more towards a 6. So who's left to buy Nissan vehicles is a higher income, better credit quality buyer out there. And at the other end, you can see that for both Honda and Subaru, since COVID, they're actually seeing that their averages have gone down a little bit, that their credit quality, they're having to pay a little bit of a higher interest rate, the buyers of their vehicles. And that may be a little bit of a pullback and subvention on their part, but it may also be reflecting this broadening occurrence in the marketplace, which is who's buying a vehicle is becoming the same buyer. And that's the other big takeaway here. On the right, you can see there was a lot of variation around the nation average, that dotted black line back in 2019. But more and more, everybody's converging towards the same interest rate, the same type of buyer out there in the marketplace. The average deviation in 2019 was 2.3%. In January of 2022, it was 1.4%. So what does this mean? Well, it means that we no longer have low FICO scores buying Nissans and Chevys and high FICO scores buying only Honda and Subaru. We have everybody with very similar FICO scores all competing against each other. And I think this means that the marketplace is going to get even more competitive as we look forward here over the next year. And what does that mean for the different brands? Well, if we put out the average interest rate out there on top of their price, we can get an idea of who might be vulnerable if we do enter into this recessionary environment. Certainly, we would expect products that have a very high price point, your most expensive products, might be vulnerable just because they are expensive. And we would expect products that cater to a customer group that pays a high interest rate. That implies that they have a lower FICO score, and so they may be a little bit more vulnerable in a recessionary environment. Certainly, as interest rates go up, people with lower credit availability are going to have a more difficult time getting credit. Their household finances are going to be more under threat. And so the variation out there as to what the impact's going to be can be revealed by this chart. I call this the vulnerability grid. And the key takeaway here is that brands like Ram and GMC, they may be under particular threat because they have very high priced products and their customer base pays a very high interest rate relative to those in the green, your Mazda, your Honda, your Subaru, your Acura. Their customer base pays a relatively low interest rate and they have relatively lower priced products. So I just think this is kind of interesting to see out there that as these interest rates go up here over the next year or two, the vulnerabilities in the marketplace do vary quite a bit. And so I just think this is something to keep an eye on as we go forward. All right, so let's dive into the used vehicle market. In particular, one of the questions I'm asked from many dealers out there is, am I crazy to be buying inventory at these prices? Am I going to get stuck overpaying for a vehicle because its price is going to crash behind me? We just don't see that happening just yet. There's very little reason to see that the vehicle market is under any kind of a threat to see that used vehicle prices are going to collapse. And the key reason being the supply is still constrained and there's still a tremendous amount of demand out there. But let's start by talking about the supply. This is looking at used vehicle supply. Where we are today, we estimate that we got about 6% more supply this year, this year than we do the same week last year. So there is some availability out there. It has improved a little bit, but the composition of that supply is substantially different, right? It doesn't have as many older vehicles. It's got a much higher price point. So that's why the sales aren't flying off the shelf. We have more of these, but they're not the same product they were a year ago. In terms of days of supply, it's starting to come down as we enter into the spring selling season, suggesting that things are starting to heat up out there. But days of supply is running ahead of last year. So we do have a little bit more availability. But as I said, the products that are available may not necessarily be what's in most demand because people are going to want cheaper cars than what we've got. So that's why sales are a little bit constrained. Right now, when we look at rolling 30-day sales, they're running down about 11% from where we were the same week last year. Now, as I said, we know that the tax returns are delayed, so that's contributing to some of this. And of course, there's all this concern about Russia and COVID and all kinds of things. But we are seeing this line increase. It's starting to rise as we enter the spring selling season. But it does seem like we're likely to be down a little bit from where we were last year because mainly the high price points, and we don't have folks just receiving thousands of dollars in government stimulus like they were getting a year ago right now when we were getting that second big stimulus check. But this is the main reason we're not seeing vehicles fly off the shelf. It's these high prices. And we can see that right now, vehicle prices in the used market are running 27% higher than what they did just a year ago. I mean, that's an incredible run up. But you can see that the story here is very similar to what we saw in the new vehicle market. That blue line is revealing what happened last year. And it was right around May of last year when the chip shortage really kicked in that we started to see that used vehicle prices started to go through the roof. And I think the thing that we really have to keep in mind is that there's still tremendous demand out there. There's not enough personal transportation for Americans, even at these high prices. And that's why we haven't seen prices come down yet. We're still scrapping in this economy anywhere from 12 million to 15 million vehicles a year. So those are vehicles that are going to the junkyard. It's too expensive to repair or they've rusted out. That's essentially what we've sold the last 2 years. So we've essentially just been covering what's already gone to the junkyard. We're not adding any new vehicles to the potential vehicle fleet. Well, the economy is still growing. And when you have a growing economy, people need more personal transportation. Business needs more vehicles. They need more delivery vehicles. So we have pent-up demand out there that's not being met. And so there's little reason to think that there was an oversupply that would cause prices to come down. The one thing we do know, though, is that as we approach this May anniversary, the year-over-year change in prices is going to start to come down. And our expectation is that we're going to see eventually, just like in the new vehicle market, used vehicle prices are going to start to follow their normal historical patterns, as we can see here in the light gray and the light blue. But we're just going to be at a different level, that we've permanently shifted to a higher level, but that we're going to start to see normal pricing patterns reemerge once again. So when we talk about the market fundamentals, we don't see a price crash ahead. We don't have the conditions in place that would suggest that we're going to have a price crash. Generally, if you're going to have a crash, you have extreme oversupply of product. We don't have that. Right now, we have acute shortages, as you're well aware. So there's not a whole bunch of vehicles out there that would suggest that we've got too many of these things. Incentives and discounts would be high and rising. Consumers are telling manufacturers, we don't want these products. You got to discount them before we're going to buy them. Well, certainly that's the exact opposite of what we're seeing in the marketplace today. And of course, we would have to see a massive pullback in demand. All of a sudden, consumers saying, we don't want your products anymore. If we were at a 17 million market right now, I might say, yeah, that's a real possibility with the war going on and concerns about inflation and rising interest rates. I could see that maybe there would be some concern that people are going to pull back on demand. But that's not where we're at. We're 2 million below that. There's still significant pent-up demand. So there's just nothing that we can see in the data right now to suggest that we should put out some sort of a price crash. Now, that said, we do think that there is going to be a little bit of a softening of prices. And our official view is that when we look at the end of the year on a year-over-year basis, we may see prices down just a little bit, maybe about 3%, just a little of the froth off of off the growth we've had. But certainly, we're not expecting to see any kind of collapse in prices or in any kind of retention values. Because the other reason for that is we know future supply of used vehicles is going to be lower, at least certainly for those hot, gently used vehicles or off lease. We estimate, this is looking at monthly lease maturities, and you can see where we are today. We're post-peak. We're expecting only about 3.9 million lease maturities in 2022. That's down from the 4 and the 4.1 million we did in the previous 2 years. So there's going to be slightly fewer, and we can already look ahead to 2023, and we know there's going to be another 400,000 fewer then. And that's from the COVID in 2020 starting to kick in and impacting the used vehicle market. We estimate there's going to be 722,000 fewer lease maturities over the next 2 years than there were in the prior 2 years. So there's going to be fewer of these. So already that's going to help contribute to maintaining high prices. The mix is going to be a little bit different. We're going to see more Hondas in this because they did some aggressive leasing from Honda, about 82,000 more. And we're going to start to see used Teslas in this mix in sizable numbers. Probably about 35,000 used Teslas coming. So that's just something to keep an eye for in the used market. We do see CPO playing a critical role. We did about 2.7 million CPOs last year. Even though we're seeing the lease maturities under threat this year coming down a little bit, we see CPOs actually taking a tick up. We're expecting to see more CPO activity because we know that these products generally sell quicker and have a higher margin. And I think more and more dealers are recognizing that this really is a good intermediary product for their buyers who are looking for new but can't quite afford it, but don't really want that old used vehicle. So I think it's filling an important niche in the marketplace. So last, let's just quickly talk about electric vehicles, because these are certainly an important product out there. And one of the important things that we've seen during COVID is that the share of the marketplace from alternatives has really taken a big jump. In 2019, about 4% of the market was full hybrids and electrics. Now in 2021, that's risen to 9% of the market. And in green there, that's just electrics. And again, that's mostly just Tesla. But that's going to be rising rapidly as we look into 2022. There's about 22 new electric vehicles that are coming to market this year. We've got Lucid and Rivian both putting product out there, so they're going to be trying to compete directly with Tesla. So a lot more products should get more interest from consumers. And we know these high gas prices is certainly making interest in electric vehicles be even more than it was before as well. But a lot of things need to be in place for electric vehicles to be the darling that everybody's hoping or telling us that they're going to be. The President Biden's goal of 500,000 charging stations, I think, is an absolute must if we're going to get ubiquitous adoption of these things and get them used across the country and not just in a few specific markets like in California or the East Coast. I think tax credits or subsidies of some kind may be necessary, particularly for the home charging that's required. You know, there's a significant investment to have your own home charging station. I think it's anywhere from $1,000 to $2,000. That's a big investment that you're asking Americans to make just to get into an electric vehicle on top of the price of the vehicle itself. So it would seem that some type of subsidy may be necessary to help that with acquisition. And of course, there's still a lot we don't know about electric vehicles. Do they have stable residual values? You know, what is the value of the new model electric vehicle that gets twice the mileage range than the previous model? You know, that's something that we haven't really seen just yet, but certainly is possible the way this technology is moving so quickly. The battery technology itself, you know, do we swap batteries? Do we keep batteries in the vehicle? Is it fuel cell batteries, or do we go with lithium-ion batteries? Still a lot of things being tested with this technology, and certainly nothing's been decided on yet. Cold weather usage. I think this makes electric vehicles particularly vulnerable in the north. You don't get anywhere near the same type of range, and it takes much longer to charge an electric vehicle in cold weather than you do in the south. We just don't know yet whether they're going to be as accepted as widely in those cold weather markets. And of course, the F-150 Lightning success, I think we do have an early view on this already, that it's already been a success. I think they've sold out and stopped taking orders at this point. But certainly the electric pickup truck was always thought to be a bridge too far, that buyers just wouldn't be interested in it. You know, no red state buyer with an electric pickup truck is going to be seen on my job site, was always sort of a tongue-in-cheek view of this. But the F-150 may prove them all wrong. If this Lightning can really sell, it means that electric vehicles can be anything to anybody, and that there really is nothing that isn't possible with this electric vehicles. The last point I just want to make, though, is I think as a country, we have to embrace electric vehicles. We've got to make these things, whether we like them or not, because the rest of the world is moving ahead. Japan and Korea have already decided that electric vehicles are the future. Europe, China have all decided they're going to have many regulations and restrictions on gas engines being sold or used in their countries. And we're already starting to hear now, even in California and other markets, about putting restrictions on gas engines being sold here in the 2030s as well. But if we don't become experts on EVs, the rest of the world and all the engineering and all the white collar jobs, the big jobs, not the assembly jobs, but the real engineering, planning, and design jobs are going to move offshore. And I think that's where we certainly don't want that to happen. So we have to keep a robust vehicle market here as well. But the other thing I just like to point out is, for all the talk about electric vehicles, we're still going to have gas vehicles for a very long time in the U.S. market. We've got 280 million light vehicles on the road today. Only a very small portion are electric vehicles, just about 1.2 million. It's going to take decades to transition to a fully electrified vehicle fleet. I mean, a good 30 to 40 years until we're going to see that happen. So I think it's the one thing you're going to have to be aware is your fixed ops departments are going to have to be very versatile. They're going to have all the capabilities to deal with these new technologies from these electric vehicles, and still be able to clean a carburetor and do all the other stuff that they have to do for these old vehicles. Generally, the older population of vehicles is dominated by the Detroit Three. They account for about 70% of the 20-year-old vehicles or more. But there's certainly all kinds of Asian and European used vehicles as well. So gas engines are under threat in terms of new vehicle sales. A lot of folks are trying to steer away from them. But in terms of your vehicle fleet, they're going to be around for a very long time. And I'm just going to finish up by talking about fixed ops. We have a metric that we're trying to develop here from our X-Time data. And we're able to look at fixed ops operations. How many tickets are dealers getting? What kind of money is being spent with each ticket? And that's what we're able to track here. And a couple of things are emerging here post-COVID. In light blue here, this is the number of tickets per dealer. And you can see that it's fallen from where it was prior to COVID. So we're not seeing as much activity in fixed ops as we saw prior to COVID. But we see in green that the amount of spending per visit or the amount of spending has gone up. And so when we look at the average spending per ticket, that blue line, that's actually gone up. And now it's looking at it's about 20%, 25% more is being spent now than it was prior to COVID. So the number of tickets or the number of orders is down, but the amount spent each one is up. So a bit of a mixed bag, but on the whole, revenue-wise, it continues to look quite strong. And I think fixed ops is somewhere that, as I'm sure you're well aware, it's going to be an important part of the vehicle market going forward, particularly with these high vehicle prices and these used vehicle values. It makes a lot more sense now to put that new engine or that new transmission into that old vehicle, because if I can just get another year out of that vehicle, it might pay for itself. So I think we're going to see a lot more interest in fixed ops to keep these old vehicles going even longer. So just to sum up real quick, and then I'll be open to some questions. I think the key takeaway here is that we're going to have a seller's market throughout 2022. We're expecting the chip shortage to improve in the second half, but I don't think it's going to be over. And I think we're really coming to the point now that we're dealing with both the ability to improve the chip shortage and supplies, and the motivation to improve supplies. And I'm not sure that the two are always on the same page. And I'm sure every manufacturer out there is really trying to do the math as to where do we need to be? Do we need to get supplies back to the levels they were before? Or should our new strategy be to stay lean and mean and keep these high price points and keep this a seller's market for as long as possible? I think right now it's a good strategy. If interest rates go up significantly higher, if we see a significant recession, we may see that the industry made a mistake by taking that approach, but we're not there yet. So right now, though, I think the year still looks like an upswing, up a little bit from where we were last year, but we're still facing a lot of risks throughout 2022. So with that, I'll finish up and open up to any questions if folks have anything they'd like to ask.
In the interest of time, if anyone has any additional questions, you can pass them along to me, and I will get them to Charlie for you. Charlie, thanks so much again for speaking with us today. We really appreciate your insight and look forward to having you back in June for another update. And hopefully things will slow down a little bit by then. To those on the line, join us back here on Tuesday, April 12th at 2 p.m. Eastern as Cox Automotive shares findings from its 2022 digital influence study. So be on the lookout for promotions on how to register. For more information about AIADA, visit AIADA.org. Thanks for tuning in and have a great day, everyone.